Hey everyone, welcome back to the Finmineering channel, where we aim to simplify mining financials and engineering. Today we're taking a look at Perseus Mining, an exciting and one of the most self-funded gold stories listed on the ASX right now. The company, already printing serious cash at a realized gold price of over $3,200 an ounce US, is sitting on top of almost $760 million of cash and bullion, plus another $230 million in liquid equities. It has zero debt and it's just doubled its dividend. At the same time, the company is fully funding two major growth projects that can almost double production. I note that the gold spot price is over $5,500 an ounce US at the time of this recording, which would improve the balance sheet even further. The company has over 70,000 ounces of gold that is hedged as at the end of December quarter, with 55,000 ounces still to be delivered over the 2026 calendar year. The company produced over 420,000 ounces over the past 12 months, for context. The company has a market cap of over $8.1 billion Australian, and it's nothing to be sneezed at for sure. Let's break down the positives, the risks, and exactly why this setup is so attractive. Perseus operates 3 gold mines in West Africa: Yaouré and Sissingué in the Ivory Coast, Edikan in Ghana, and the 2 big growth projects. One is the CMA Underground at Yaouré and the Nzanga project in Tanzania. At the end of the first half of FY26, revenue was just over $600 million US, which is 5% up year on year despite lower sales. Production was close to 190,000 ounces at an all-in sustaining cost of $1,649 per ounce US. The realized gold price was $3,241 per ounce, which is a cash margin of almost $1,592 per ounce. Net profit was $185 million US. Cash and bullion is still $175 million after capital, tax, dividends, and buybacks. That's a seriously strong result in today's gold environment. Let's go mine by mine. I want to address the ownership issue up front. Perseus holds a majority control stake in all 3 producing mines, with a standard free carried government interest. These are passive economic states only. The governments receive their share of profits and productions but contribute zero capital and have no operational or board control. It's a proven model that aligns incentives and keeps government supportive rather than adversarial. Specifically, the Edikan mine is owned 90% by Perseus, the Yaouré is owned 90% as well, and the Sissingué mine is owned 86%. The structure seems to be working well. Perseus employs 94% of its workforce from local nationals and contributed over $800 million directly to host economies in FY 2025 alone. No forced nationalisation, no operational seizures, nothing like that at any of their sites. Now let's look at the numbers. The Yaouré mine is the standout. Over 87,000 ounces produced at an all-in sustaining cost of $1,519 an ounce US. It's transitioning from the CMA open pit, which is now finished, to the Yaouré pit with huge stockwalls as a buffer. First ore from the CMA underground mine is already delivered in January 2026, and stoping is expected later this year. This will lead to high-grade feed that will extend the mine life. The Edikan mine has been rock solid. It produced over 71,000 ounces at an all-in sustaining cost of $1,566 an ounce. The pit seems to be performing well. Sissingué is transitioning. It produced over 30,000 ounces of gold at an all-in sustaining cost of $2,226 an ounce. The satellite phase is complete and higher grade pits are now ramping up. Group all-in sustaining cost was higher this half, mainly due to royalties from elevated gold price, plus voluntary extra 2% royalty paid in the Ivory Coast during ongoing fiscal negotiations. It was only about a $9 million impact, and even with that, margins remained excellent. At the end of 31 December 2025, cash and equivalents was over $680 million, gold and bullion was just over $70 million, plus liquid equities of $230 million. As mentioned before, the company has zero debt, and its debt facility was just upsized to $400 million, which remains undrawn. Net tangible assets per share is up 63% to $1.58 US. The company is returning capital as well. It declared an interim dividend which was double at 5 cents per share Australian, which is to be paid in April 2026. The FY25 final dividend was also 5 cents per share. A $100 million Australian share buyback scheme has been renewed and the company is actively buying shares as at February 2026. The company is self-funding its growth and the company is rewarding shareholders. I think this is the right strategy in the current environment of elevated gold prices, where the company is focused on organic growth and rewarding shareholders. In terms of growth projects, the CMA mine at Yaouré, as I mentioned before, first ore was already delivered in 2026. Stope ore is ramping up in Q4 FY26, and it would be the Ivory Coast first mechanized underground mine, which may have some teething issues, which is something to watch out for. Nzonga, which is 80% owned in Tanzania, just last week in February 2026, reported a 73% increase in reserve to 4 million ounces. It can deliver 200,000 ounces per year for over 14 million years, starting in FY 2028. First gold is expected in January 2027, which would be on time, on budget, and fully funded from cash. The 5-year group outlook between FY 26 and 30 is expected to yield between 515 and 535,000 ounces per annum on average, at an all-in sustaining cost of between $1,400 and $1,500 an ounce US. That's before the full Nungaza mine. Once that is online, the potential is to reach between 650 and 700,000 ounces per annum. The FY26 guidance is unchanged, expecting to deliver between 400 and 440,000 ounces at an all-in sustaining cost of between $1,600 and $1,760 per ounce US. Let's talk about risks. Of course, real risks exist, so let's cover them head on, including the government ownership angle. Firstly, let's look at fiscal pressures in a high gold price environment. This is the main watch point. In the Ivory Coast, the royalty structure reset to a flat 8%, backdated to January 2025, up from the previous sliding scale of between 3 and 6%. Industry initially disputed it under existing conventions, but Perseus paid an extra 2% in good faith during the negotiations, which totaled approximately $20 million across periods. Talks continue, but there has been zero operational interference, just higher costs that are already in the guidance. In Ghana, broader law reforms are proposed, including higher royalties, but again, nothing has hit Edikan specifically. In terms of reputational and geopolitical risk from government stakes, actually this is a low risk at this stage. The standard free carried interest that is in place at the moment give government skin in the game without giving them operational control or funding obligations. They align incentives and help keep relationships constructive. There are no reports of adverse government interference, nationalization attempts, or forced changes at any of the Perseus operating mines. Perseus has a strong local employment track record and is creating massive economic contributions to further reduce reputational risk. In terms of production volatility during transitions, we saw a little bit of this in the first half, especially in Q2 FY26 at Yaouré, but it was partially mitigated by some of the stockpiles and the underground ore starting to come online now. In terms of safety, there was a tragic event at one of the contractors during January 26. These things are always a risk, and we would be looking for the company to strengthen controls. In terms of execution on two of its big projects, these risks are always present, and it's something for us to keep an eye on, see how they are progressing. Gold price, well, that's an obvious one, but the company has a reasonably low all-in sustaining cost, which provides a fairly big margin of safety. At $6 a share Australian and a market cap of almost $8.1 billion, you're getting the lion's share of 500,000 ounces of gold production and close to $760 million in cash and bullion. 2 fully funded growth projects, growing dividends, and an active buyback. The company seems cheap versus peers. No one knows how a rock will break, but if the bull case continues, expect doubling of production, huge returns, and supersized dividends with extensive share buybacks. Even at moderate gold prices, the fortress balance sheet keeps the dividend growing and buybacks rolling. This is a self-funded, debt-free, majority-owned gold champion with major-like financials and developer-like growth, and it's trading at mid-tier prices. In my view, it's a company worth keeping an eye on. But I'm interested to know what you think of Perseus. Please drop us your comments and thoughts below in the comments section. Please keep in mind, this is not financial advice. Always do your own research. The opinions in this video are my own, and all the content is based on publicly available information. Thanks for watching, and until next time, see ya.